In 23, the big banks were doing great. We got into the first quarter and people started worrying about a recession. So you saw a big sell off in some of the large caps, and I couldn't believe it. You literally saw managers run away from the industry in the first and second quarters. Third quarter, they started coming back. And now I think you're going to see the thing melt up. I think they're going to go higher.
Bank earnings season has begun, and we are joined by the best banking analyst, Chris Whalen of Whalen Global Advisors. Chris, great to see you. What big trends have you observed from the big banks, and how are you thinking about their health, their profitability, and their future prospects?
This quarter is a good quarter on the capital markets side. We had a considerable rally in the third quarter as everybody anticipated action by the Fed. A lot of companies went to the debt markets to refinance themselves as yields fell. And so overall, it was a very good quarter. You were mentioning Jefferies to me before we started, and Goldman, Morgan Stanley, even Bank of America all saw a nice bump on the capital market side. Not so much the equity markets, but debt. So I think third quarter was probably better than anticipated because of the rate rally. The issue I think going forward is that the Fed may not do a whole lot more in the near term because of some of the economic numbers and the election, obviously. So we'll have to see what happens. I would really be surprised if the Fed acts immediately after the election, but who knows? I think if Trump wins, so you probably see Jay Powell resign. I think he's had enough. Trump can't remove Powell from the board, but he can appoint another chairman. So, the politics of this are pretty clear, I think.
Right, so that November Federal Reserve meeting right after the election, the market currently is pricing quite a high 90% chance of a 25 basis point cut. But maybe you think that will be all the Federal Reserve will do, which could put a stop on the capital markets activity. As you say, Goldman investment banking fees up 20%, JP
Yeah.
Morgan investment fees up 21%, Jefferies investment banking fees up 39%. So there is a new bull market in investment banking fees, mainly related to the underwriting of debt, as you say, not equity. So initial public offerings, not so much. It is much more about bond issues and leveraged loans, perhaps some CLOs in there. Chris, are interest rate declines good or bad for the banking system?
Well, the interesting thing is if you look at the data from the individual banks, their yields have been falling and their cost of funds isn't. So cost of funds for the industry and for the top 20, 25 banks has been stable for the last three quarters. That's fine. Nobody minds stable after the past couple of years, right? But because of the competition for assets, loans, securities, whatever it is, yields have been falling. So I think you're going to see net interest margin get a little bit squeezed again. And remember, it's been flat going back into 2023. So the industry is kind of paying for those good years that the Fed created with very low interest rates. And now we're kind of stagnant. We don't have a lot of lift in terms of asset prices. And if anything, yields are falling in certain sectors.
So yields are falling, and that's a bad thing for banks, but it actually could be a good thing for the people who are the borrowers.
Oh, yeah,
Uh,
it's great for issuers. We've had an issuers market for the past 4 months, Jack. You see it in the gross numbers for underwriting for debt and all sorts of other issues. Everybody waited as long as they could, and then they rushed to the market. But I also think that they know that these yields may not be that enduring. We may see yields rise again, and that's what's happened if you look at the 10-year.
and yields rising not because the Federal Reserve raises the short-term interest rate, but because
No,
the cuts, explain for the audience, the cuts that are priced into the 10-year may not appear. Uh,
that's right.
yeah.
The Fed controls the short end. That's always been the case. They've nationalized Fed funds. We don't have a Fed funds market now. I thought it was cute that the Fed just published a research paper trying to determine the relationship between reserve and Fed funds. But they control Fed funds, so we shouldn't even talk about this, right? The long end, they don't control. And that's where I think the animal spirits are going to make their views known in the next few months. Because the Treasury's in for another big refunding. And that's really the issue.
Chris, are you a bearish on the 10-year note? You think it's going to go higher?
I am. I think it could continue to back up. Strangely enough, everybody in mortgage land was talking about going below 6%. And now I don't think it's going to happen.
So mortgage rates have gone up after the Federal Reserve did its first and so far only
Yeah.
50 basis point cut in September. That is a little bit weird, isn't it?
Well, yes and no. They went down a lot in the third quarter. We got our rate cut even before the Fed acted. So I think the anticipation of the markets changed the timing a bit. It brought it forward a couple of months. And now the question is, what do we do next? I think you've got at least one, if not two, no votes for additional rate cuts in November.
Mhm.
So, Chair Powell doesn't like a lack of consensus. He tried very hard to have a complete unanimity for the first rate cut. Nikki Bowman demurred, obviously. She wanted just 25. But I think you could have a couple other governors ready to vote no next month.
And Chris, here I'm going to ask you a question where the answer you're thinking you're going to give might disappoint or anger our audience. But what
Oh,
is your
go ahead.
view on the delinquencies, credit defaults, um, in terms of consumer credit cards, auto loans, commercial real estate? I mean, we have a chart of credit card delinquencies, and they are higher than they have been since I believe 2012 or 2011. They are not as high as throughout most of the 1990s.
No.
But what do you say to people who say the economy is doing very poorly because delinquencies on credit cards are so high at a multi-decade high or a decade high?
When you look at just bank credit cards, they're pretty pedestrian. They really don't look bad at all. However, when you widen your analysis and you take in the non-bank issuers and the subprime credit card market, subprime autos, you see a lot of delinquency. If you look at the FHA market for mortgages, over 10% delinquency. So I think this story about default is really the bottom quarter, bottom third of the stack, whereas the top two-thirds of more affluent borrowers, you see nothing. It's like we have two different economies here. And I've been saying this for a while. I don't think a lot of working people ever recovered after COVID. And then we whacked them with inflation immediately after that. And that's taken a terrible toll on consumers, low income consumers. And then we come up with all kinds of crazy ideas for how we could stoke demand, which is only going to increase the price of housing even more. So I don't know. This whole period has been tough for working families, and I do worry about that. So I'm not disagreeing with them. I'm just saying if you segment this into bank and non-bank, the banks look fine. There is no problem. Even Capital One, some of the other issuers that are a little more edgy in terms of default targets, no. But then you go look at the non-bank issuers, and they have very high delinquency rates.
What would it be an example of some non-bank subprime credit issuers, either in credit cards or in autos?
Oh, well, you can find them all. They're in the securitization market. There are many, many issuers to manufacturers. There are a lot of subprime issuers. These are all private companies by and large. But if you go on the website for Kroll or Fitch or any of the major rating agencies, they have great pre-sale reports that go into exactly what's in these deals, and they show you the delinquency rates, the default rates, everything else. And it is two worlds, believe me. The banks have stayed out of subprime auto, even though the yields are higher, because they can't make any money. They stay in prime because it's mostly a customer business. Are they making a lot of money on those auto loans? No, not really. They'd rather do a commercial loan with a lower risk weight. So, I think it really depends on, the segments, but you have all sorts of people. You have SoFi involved in this market. You have all different non-bank issuers who don't just do mortgages. They don't do, refis of student loans and things. They do all kinds of things. And
Chris,
that
isn't SoFi
market
a
has
bank
grown
though?
a
Don't
lot.
they have a bank license, or do they use another bank?
No, they have a bank license now. They
Um,
are a profoundly mediocre bank. They need to grow. SoFi needs to double in size before they can really, I think, be stable as a bank holding company.
Chris, I feel like a lot of analysts who I respect have a somewhat negative view on SoFi, and the people who say nice things about SoFi, maybe they don't have as much experience as the other
Yeah,
people. I think you're one of the few people of Chris who I really respect your analysis, but you have a more positive and sanguine analysis of SoFi. What is your view there?
the credit side doesn't look too bad right now, and I emphasize right now. We got to see them go through a cycle before we can really understand how good their cooking is in terms of credit. On the other hand, like I say, they're still too small. They got to get bigger. They are competing with giants. If you think about why Discover is selling itself to Capital One, because they have to. $100 billion is too small. SoFi is half that size. So they need to get bigger. And I don't know how they're going to do it because, growth in this market is tough. you have everybody and their mother from JP Morgan on down looking for the same assets. Some are more picky than others, but SoFi, their funding costs are still relatively high. They're kind of like Ally in that sense. They don't make enough on the asset side to really make me feel like I'm getting return for money in terms of risk. And then on the other side, they're too small to have a good funding base. You look at somebody like J.P. Morgan; he's killing it because of his funding costs. By the way, who has the lowest funding in the top 100? Ameriprise. Think about that. Even less than Schwab. Schwab used to be the lowest, but not anymore.
By the way, Chris, you're right about Schwab. A lot of people, myself included, were a little bit worried that Schwab had such a large amount of long duration paper and securities, and
Yeah,
that their interest expense would rise. Their deposit base has been quite stable, and they
yeah.
actually are paying back some federal home loan bank funding, so
Oh,
replacing it
yeah.
with much cheaper
Well, they
funding.
have
So
to.
you were right, and I was
That's
wrong.
right.
Chris, just to your point about the bifurcation within society,
Yeah,
I see that with looking at the different banks and credit card company issuance. So, for example, American Express, their delinquencies and charge-off rates are barely up year over year. I think like 1.3, 1.4%, and
yeah.
they're well below 2019 levels. And
Right.
their loans grew at 6%. So, high Amex customers, typically a high-income customer, they are spending more money and they are doing fine. Whereas Bank of America, their purchase volumes are basically flat year over year, and this means that basically, if they continue to grow their purchase volumes, delinquencies would have gone up even more. So the
Yeah.
banks are basically cutting credit off to the middle income and lower income consumers. Capital One has not reported yet, but
Mm.
Synchrony, where a lot of people have Synchrony cards even if they don't realize them, their purchase volumes are down 4% year over year, which, adjusting for inflation, means that the real spending is down 7%. So is it fair to say that a lot of American society, maybe the bottom half, bottom quarter, you tell me, is kind of being cut off from credit? Or another way to put it is that the boom in consumer credit over the past few years is over or is ending.
Well, it is because if you inflation adjust those volumes and those balances, they're down. Credit card utilization in the U.S. since 2008 is down. Same thing with home equity loans. And I think part of it is that younger people are very shy of debt. They see what debt did to their parents during the crisis, or even after, and they don't like it. They want to live in a more independent way. And if that means they spend less or they spend cash instead of taking on personal debt, so be it. The industry would be delighted if people would use their credit cards more. There's $4 in unused credit for every dollar out there that's utilized. So, I think the industry is killing itself by charging people so much because the default rates really aren't that high. And yet kept credit card rates are way up into the 20s, which I think is inappropriate. It's the most profitable product for most banks. Think of
Right.
it that way.
Yes, and Chris, there are people who are doomsaying about delinquencies of credit cards are up to 4%, 5% net charge-offs. But again,
Oh,
if banks are making 15%, sorry, charging 20%, as for example Synchrony does, I think 21%,
yeah,
their return after they take out defaults is 15%, and then so it is a very
yeah,
very profitable business. And yeah, I
yeah,
think there was a
yeah.
boom in consumer credit from the late probably 1980s till 2007 that obviously popped in a disastrous fashion. And since then, people have been less willing to take on debt. So even though in the U.S. government is incredibly levered and much more has much more debt out there, on a personal basis for consumer debt, I think we're still below pre 2008 levels. Once you properly adjust it for
Well, don't
GDP
get too
or personal
excited.
income.
I did a picture about how the BRICS aren't going to supplant the dollar in the blog today. Remember, the U.S. may have a lot of debt, but we have enormous assets.
Mm-hmm.
We actually have transformational assets, energy, everything else, and hundreds of trillions of dollars. So I'm not particularly worried about this, and I'm definitely not worried about Vladimir Putin and Xi Jinping, both of whom have no idea about economic anything. They're going to destroy their countries if we don't see political change in those nations. So I don't wring my hands. We could fix the budget deficit and all the rest of it tomorrow, Jack. Me and you, we'll go to Washington, no problem. You know,
Yeah, I mean, if you want to go even further, you could say the Federal Reserve can just pay it all off.
Well, listen, in the new version of inflated, I dangle that possibility. If you think about how we created the fiat dollar during the Civil War, how do you fix the problem? You just turn the debt into currency. Because,
Right.
that paper I've cited a few times in my writings, Lev Menand and Josh Younger,
Yeah.
uh, about the legal, background of the dollar. Well, what they're saying in there is that T-bills and greenbacks are the same. One bears interest, the other doesn't. But that reality, I think, should always be in the back of everyone's mind, because that's how our system works. That's why we're not being replaced. The fact that we have a currency that is exchangeable in the liquid debt, and you can use that debt as collateral in financing transactions, is extremely powerful. It's not just about the dollar; it's about the entire dollar complex behind it.
Right. And I think that for the second Bank of the United States, the debt accrued from the War of 1812 became equity in the second Bank of the United States. So there's history
How
in there.
appropriate.
Yeah. Chris, on the mortgage side, you're very connected to the mortgage world. Can people watching this do you expect that their mortgage rates will go up even higher? Of course, this is the new mortgage rate. That's the whole thing about mortgages is that it's a fixed rate. And
Hmm.
just how much does that impact the banking system, Chris? You have been a really great on this theme of long term banks have owning all of this long duration paper that they can't get rid of. And the issue the
Yeah.
banks have had is not so much defaults. It's not that they're not
Oh
going to be paid
no.
back. It's that they are going to be paid back not nearly enough money because they bought all of this long duration assets at a 2% yield when interest rates were at zero. And now interest rates are at 5%. And that was no longer good enough. So banks have been dealing with this issue for over 2 years now. And, Bank of America, they have a lot of unrealized losses. Schwab, a lot of unrealized losses. Uh,
Right, but they're not
eBay,
going to take them. You see, you got to realize the pain is not because they're going to go out and sell the security and lose 10 or 12 points, right? It's because they're only getting 2%. I have a 3% mortgage that is sitting inside a Fannie Mae 2 vintage February 2021. At most banks that hold that paper, and the Fed, by the way, their cost of funds is higher. So every quarter they're losing money. That asset's underwater. And over time, I think imagine if we had a real rate rally. Imagine if rates fell another 100 basis points from where we are today. I think a lot of banks would take the pain. They
mhm.
would go out and sell that paper as fast as they could and reinvest it in other securities, other loans. So, the banks were not anticipating the magnitude of change that resulted from 2019 to today. They really weren't ready for it. The Fed signaled to everybody, inflation is temporary, transient, and all the rest of it. And they took that advice, which was a bad idea. So, but there are so many banks, JP Morgan, all the rest of them, who didn't take their eye off the ball, Jack. They knew what was going on. They knew that they shouldn't believe the Fed, and they believed the markets, and they did very well.
Yes, they did. And of course, Chris, if interest rates were still at zero, it would be Bank of America and Schwab and Silicon Valley Bank and First Republic Bank that they would look like geniuses. And people would say, why did Jamie
Well, they
Dimon stick in
did.
all this floating rate paper? Interest rates are still at zero. So,
Yeah.
we can't be too harsh. But I mean, if especially the large banks a lot of what they own, so much of what they own is mortgage backed agency mortgage backed securities. Again, no credit risk, all duration and convexity risk, and those products suffer enormously from interest rate volatility. You can only expect that the banks themselves will suffer from interest rate volatility, the
Well,
likes
it
of which
hurt
we've
their
had over the
earnings.
past 5 years.
Yeah, it'll hurt their earnings. There won't be anything catastrophic here, but it's kind of like a wasting disease. Bank of America's got over $800 billion worth of securities, and the yield on them on average is about 3%. They pay more than that for money. So, that whole part of their balance sheet is basically a toss up. So,
Mm-hmm.
where they have to make money on the capital market side, that's not a great situation because it means the balance sheet is illiquid and they don't have the ability to manage it in the way that they would like. So, it is what it is. I tell people you have to manage to today. You can't manage to what you think is going to be the case 3 months from now. You have to make decisions today. And I think for a lot of banks, if they have the capital and the income to go clean house, they should do it. They really should. There's a lot of attractive assets they could be buying today.
Right. And even if banks don't have a huge amount of securities, a lot of them entered into interest rate swaps. And people say, oh, that's great. They hedged the interest rate rise. No, they hedged the other way. They hedged the wrong way. When interest rates were at zero, they
Yeah.
hedged interest that the risk of interest rates going down.
But here's something for you to think about. One of the things that's pushing up mortgage interest rates is the fact that banks are sellers of these securities in the synthetic credit risk transfer deals.
Mm.
So there is a steady flow of sales, even though they're not quote unquote selling the asset, they are trying to lay off the risk and do, I think positive things with the proceeds. They raise cash, they sell part of the risk on their portfolio to a private equity fund, and then they take that cash and they invest in higher yielding securities. That's a good policy.
So, Chris, a lot of banks suffered as
Hmm.
the interest rates shot up so much, and their balance sheet did not suffer. It's an earnings.
I think so. You're not going to see them taking big hits by selling these securities in large quantities unless you see a real rally. Like I say, if you were to get to 10-year down 50, 75 basis points from where it is, banks would be incentivized to sell. Look at somebody like Schwab, which we have talked about a lot over the years. They are slowly shrinking the bank, cleaning up whatever mess they had in terms of low income securities and growing the most important part of the business, which is AUM on the
Mhm.
advisory side. I thought it was tragic when TD Bank announced that they were going to sell their Schwab stock so they could pay their anti-money laundering fine, which was just a tragedy. I think they should do the opposite. They should sell their U.S. retail bank and put all the proceeds in the Schwab. I think it would be a better investment. Oh God, retail banks are loss leaders. How do we make our friends and cousins in Canada understand this? They keep coming down here and buying second tier retail banks, and they get their clock cleaned. And I throw up my hands. I've been talking to them for 20 years, Jack, and they don't want to hear it.
And so, Chris, do you think that the 10-year going down, regardless of what you would think is actually going to happen, do you think if the 10-year were to go down, that would be good for banks, and the 10-year going up would be bad for banks?
Oh yeah, if it goes up, let's imagine 10-year goes back to 5%. That raises some particularly serious solvency issues for the industry. That means the industry would be insolvent by a couple $1 trillion. And I really think that that would be a crisis. You've had proposals from Treasury to buy back some of these low coupon securities and issue new ones with current coupons. But even that's not really a fix. The insurance industry got a dispensation from their regulator. They can take losses over a period of years. And in the new Basel proposal, the same language is included for banks. In other words, if they sold a Ginnie Mae 2 today, took a 12-point loss, they could report that loss over a couple of years instead of having it hit all at one time. And I think those kinds of approaches are valuable because otherwise we're going to have banks just sitting here taking interest rate losses. Imagine where the cost of funds would be if the 10-year was back at 5. Think
Mhm.
about that.
Got it. So you think that the 10-year going up would be bad for banks,
Oh,
and the
yeah.
10-year going down would be good for banks. I think that
Sure.
contravenes a little bit of commonly held wisdom, Chris, because
I know,
people
but the
say that
wisdom's
people say
wrong.
that banks like steep yield curves, right? And the 10-year going up would steepen the yield curve.
No, no, no. But remember, it's not about the absolute rate of the yield curve. It's about the spread
Mhm.
between funding and the yield curve. You got to always think about spreads. That's how banks make money. It has nothing to do with the actual rate of interest. In normal times, banking was basically a fixed margin business. But with market volatility, that got thrown out the window. I think that you always have to remember the banks have a large chunk of their balance sheet run off every year. So 10, 20, sometimes more percent of a bank's balance sheet can go away in a year, and they got to go take the cash and buy something else, right? So they're always on this treadmill. And you got to think to yourself, if rates fall, I'm going to make more loans. I'm going to sell those loans for a gain on sale. I'm going to make money on my securities. And also, I can sell some of those old 2% securities I'd really like to get rid of. So that would be a winner. Just when people tell you, oh, rates are going up, that's good for banks, those people have no idea. Just move on. Don't even talk to them.
Yes, there are some banks that benefit from interest rate rises, and Banks
Yeah,
benefit from very slow, a 2016 style, but the interest rate
yeah.
shock of 2022, it's bad for the
Well, the
business
banks
model.
who benefit from rising rates are the guys who have tiny securities portfolios that they keep it available for sale so you know exactly where they are. And they're mostly making loans. These
Yep.
are people who are out putting assets on the balance sheet, keeping them, underwriting them correctly, and they make money. Banco ZK, he does construction lending, very short duration, very high coupons. I like
I
it.
was I was just about to bring that up. Chris, tell us about commercial real estate. People have been crying and whining about
Mm,
commercial real estate for literally 3 years now. I mean, in some cases, 4 years. And okay, we get it. People are working from home. I mean, we're both recording this from home. People are not going into the office as much, and that
right.
maybe is going to impair the credit. But I mean, people still go to people still live in apartment buildings, right? I mean, I think just my review of a large commercial real estate holdings, for example, Wells Fargo, of the banks that have reported so far, their delinquency rate is not, it's like 50 basis points, which is not that high. Where is this commercial real estate doom, Chris? Because people have been, I've been
Mhm.
interviewing people and they've been promising me it and my viewers it for 2 to 3 years. What's going on here?
Well, you don't see a lot of the pain in commercial real estate in banks. Banks tend to have senior exposures to these deals. They don't like to go first. A lot of these deals get funded in the bond market. They end up in commercial mortgage backed securities. And they're also financed by REITs, private REITs. So
Mhm.
you can't see that either. The only time you're going to see it, the pain that you're talking about, right, is when an event occurs that ends up in the public domain. So a default occurs, somebody files for foreclosure on a major commercial property. What I always tell people is subscribe to the news feed from the real deal. Okay. And just look at the headlines. You don't even have to read the stories because they're too depressing. But the amount of creative destruction in commercial is vast, Jack. Give you a sense, Florida, where everybody's been moving their headquarters, building new office buildings, right, is the worst in shape it's been in a decade. It's worse than before COVID. And why? Because the older properties are going begging. Their valuations just plummet as soon as somebody builds something new down the road. So Florida is a basket case. Many other states, Illinois, they're all having their problems, but this is not a bank story. This is about private developers, the bond market. It's about private equity funds, sovereign wealth funds. You wouldn't believe who owns some of this stuff. And big buildings are trading at pennies on the dollar. So trust me, there are losses here, but this is not a consumer market. You're not going to hear about this. The news is just going to dribble out. So and so bought this building for nothing. I'll tell you one of the real hot areas is New York City. All the rent stabilized properties, they're going for pennies on the dollar. And the FDIC still owns a lot of that. So if we see Trump in the White House and you have a new FDIC chairman, they're going to sell all of that property in New York for nothing. They have to. And that's going to really open people's eyes to see what the cost of rent control is.
Right, Chris. So I totally grant you there are lots of players in the commercial real estate market who can bear the pain who are not banks. There's the real estate equity investors. So commercial mortgage-backed securities, they fund commercial real estate. You didn't mention that, but insurance companies, massive lenders to
Oh yeah,
commercial real estate,
oh yeah.
and the huge banks really are not a large as a percentage of their assets lender to commercial real estate. I grant you that. Wells
Oh,
Fargo is an
it's a couple
exception.
trillion dollars. Non-owner occupied real estate for banks is a couple trillion dollars. It's not small, but I don't think you're seeing the kind of default activity there that you're going to see in other areas of commercial real estate. The loss rates are very high. When a default occurs for a bank commercial loan, they're losing almost 100% of the original loan amount. So it's not like this is good. This is bad. The default rate on residential mortgages is still negative because of home prices. Think about that. You couldn't have it more different. And multifamily bank loans, which is another large asset class for banks, are just completely they're as worse as bad as commercial office buildings.
Okay, but Chris, how much of that is because of rent control? I mean, rental prices are
Oh,
still going up a ton, and the occupancy rate is very high for multifamily, which is part of commercial real estate. So I
yeah.
understand if there's a rent controlled property, how the landlord can't raise the rent enough to offset the huge interest expense. I understand that happened with New York Community
Well,
Bank.
maintenance, forget about interest expense, just taking care of the building. In New York, you cannot recapture the cost of rehabbing a building. The politics in New York are just silly. So until that changes, how do you get investors to come back? They're all down in Austin and the Carolinas building new properties. Why should they build in New York? Same thing with Illinois. Illinois has gone crazy too. So, as long as the politics are like that, builders will migrate away to other markets. They're very
Yes, I mean,
mobile.
I do think that rental prices are like 20 to 30% higher than 2019. So definitely landlords have been doing well. But Chris, is multifamily, aka apartment buildings, an issue outside of this rent control thing?
Yes, because most of the assets that are held by the banking industry and by the bond market are not rent controlled. And
Mhm.
if you look at the loss rates, they're quite high. Immediately after COVID, loss rates on multifamily real estate just surged right back up to 100%. During COVID, you had forbearance. You really couldn't tell what was going on. But commercial and multifamily normalized almost immediately, 2022. Whereas, consumer, credit cards, autos took a lot longer. They're kind of sort of normal now, except for residential. But I think this time around, this cycle, Jack, is about commercial and multifamily. And even properties that you would think are fine, that are not rent controlled, are still going to go through the mill because the owner, quote unquote, who has debt, got badly damaged during COVID. He had 2 years where people weren't paying their rent, didn't get any help for this, remember? And the company eventually fails.
Chris, you could convince me of two things. I could be convinced quite easily. Number one is that commercial real estate is going to be a disaster, as people have been saying for many
Oh, it
years.
is. I
And
think we're already there.
the second, Chris, is that the banks won't be affected by the commercial, or they won't be affected that much by commercial real estate. But how can you convince me of two things? Because the banks do own, especially the regional banks, a lot of debt to real estate. I mean, Bank of the Ozarks, OZK, a bank that you like very much, they have a lot of commercial real estate debt.
No,
And
no, 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 no. They have a lot of construction loans. Don't mix up your terminology, Jack.
but
Long-term mortgages on commercial properties are 7 to 10 years. Construction loans are 18 months. Big difference. You
So
want
they're less risky from a duration perspective. But Chris, wouldn't to me it seems that a finished building is a less risky proposition than a unfinished building.
maybe, maybe, but wouldn't you rather get out quicker? You see, the construction
Maybe.
is funded. They've already got the money that says, okay, here's 50 cents on the dollar in debt. I've got 50 cents in cash. I've got some backup capacity. Let's go build the building, right? Then you get out. And then it becomes somebody else's problem who takes the long term mortgage. I personally would always rather be in the construction side. It's funny. I've been helping a bank think about what markets they should get into. And I said, it's very simple secured, short term. Okay. You don't want to take time risk. You don't want to trust people. You
Mhm.
want the shortest possible duration you can. That's what you want in this market right now.
Right, but we say secured. It's secured by a building that's not finished, right?
Oh, yes, that's right. But it's new. Everybody wants new. Would
Fair.
you rather have that construction loan on the new building on the block, or would you rather have a mortgage on that legacy building with the beautiful ceilings?
Mhm. And Chris, earlier you compared assets on a bank balance sheet running off compared to a treadmill. I think in 2022 and 2023, that treadmill was extremely slow. It was on a walk setting because agency mortgage-backed securities paid off. The prepayment rate was extremely low. In 2020, it
That's
was
right.
extremely high because everyone was refinancing. Now, very few people are refinancing.
But that's a
Uh,
small part of the book. Mortgage-backed securities for U.S. banks is less than double digits. The rest of the book runs off pretty fast. If you look at the average life for
mhm.
JP, it's probably around 4 to 5 years. So
Okay.
20% of the book disappears every year.
Mhm. But a beneficiary of the slow treadmill of low conditional prepayments, CPRs, is mortgage servicers, right?
Oh, yes.
Yes. Tell
Wonderful.
people about the mortgage servicing business and how strong that market has been because the prepayments have been so low. And I guess you just look at a stock of, for example, Mr. Cooper, which is
Yeah.
on fire. Explain that.
Well, what's happened is as interest rates fell and then rose again. The mortgages that were created, which was about 2/3 of the $13 trillion worth of residential mortgages, were all refinanced. So they're sitting there, and the owners have very little incentive to sell. In fact, they have every incentive to shelter in place. So that part of the book is not moving. And for a mortgage servicer, well, this is gravy, because whereas, in the past, they might have expected that mortgage to prepay in 3 or 4 years, now the average life is more like 10 years. And so what it means is that the cash flow coming into those companies is enormous. The valuation for the mortgage servicing assets has gone up several fold. And the competition for these assets from institutional investors has become intense. It's so intense, in fact, that only the traditional shops, you mentioned Mr. Cooper, my friends at Freedom Mortgage, I just published a book about Stan Middleman, which I urge people to read if you're interested in mortgages. Stan witnessed the rebirth of mortgage finance in the 1990s. That's when he got started. And then he saved his pennies and reinvested every dollar he could back in the mortgage servicing assets. And today he's really the price leader in the market. Nobody wants to compete with him. It's quite amazing. He's got $600 billion worth of servicing on his book. So that provides future income for the company. It provides the opportunity to refinance the customer. And they have all sorts of other opportunities to sell the customer ancillary services because they are the servicer. So it's very important. The biggest benefit of mortgage servicing assets, other than the periodic cash flow, Jack, is just the fact that you have a relationship with the consumer. You have the right to call them on the phone, say, hey, you want to refinance your mortgage? They do that. That's worth a couple of years worth of servicing income. So it's a home run.
Right. And in the same way, a mortgage-backed security, if no one ever refinances, you'll get 30 years of interest payments. But if
Yes.
everyone refinances that year, you'll only get the interest payments for 1 year. A mortgage
Oh, yeah.
service is if you want people to basically not you want people to not refinance, because then you will continue to clip the coupon, or you'll be servicing every year. So they benefit as when prepayments are
Well,
low.
I think mortgage lenders, if they were sitting with us today, Jack, they would tell you that they want to do the right thing for the customer. If rates fall, you want to call that customer and say, hey, you can refinance your mortgage and save some money. Or even better, refinance the mortgage and go to a 15 instead of a 30-year and pay it off quicker. See, that's where the mortgage industry, I think, is at their best. When they offer people opportunities to save some money, especially people like VA borrowers, for example, I think that's great. That's where the industry does. And also during COVID, the industry refinanced and handled forbearance for millions of Americans and didn't get paid a dime for it. They made a lot of money making new mortgages, but they kind of had to spread the wealth around, if you know what I mean.
And Chris, what about companies where they have an originate and sell model, where they make
Mm.
mortgages and then sell them to another bank? An example is Rocket Mortgage. That stock got all these stocks got killed as interest rates go up because no one was going to refinance in 2022 and 2023. They've been
Right.
budging up from their very, very depressed levels. Are you a bull on these originate and sell mortgage lenders?
No, there are two schools of thought in mortgage lending. You have the traditional school, which is, I think, really represented by people like Stan Middleman at Freedom, Cooper, Lakeview, which is part of the Bayview complex. All of these guys, when you sit down and talk to them about the industry, the first thing they think about is the mortgage servicing asset, not the loan. Then you have people like Rocket, some degree Penny Mac, and others who have MSRs. It's not like they don't keep some of their servicing, but they also are very aggressive about making loans and selling loans. And I think that model really cuts these people short. I think you're much better off focusing on the servicing asset and maximizing that, because honestly, I think we're going to have less interest rate volatility going forward. And if I've got a book full of twos and threes and mortgage rates are at 6, I'm going to sleep very well, because I know that book's not going to prepay. People will die, they'll move, they'll get married. Other than that, there's not going to be any prepayment activity on that book.
Right. So you are bullish on Rocket, or and that originates sell
No,
model?
I would prefer, if you ask me, I would prefer Freedom or Cooper, or those more traditional borrowers, Rhythm, Mike Nierenberg's firm. They
Mhm.
love MSRs because they understand it. They understand the cash flow. They understand the optionality of having a relationship with the customer. So no, I like the traditional guys. I'm not into the originate to sell model. I think it's very high risk. Look at United Wholesale Mortgage.
Yeah.
He's been selling his MSRs to finance his cash burn because of the price war he's been conducting in the wholesale channel. The moment he stops doing that, everybody's going to come back. You can't keep them out forever. You can force prices up. You can pay a multiple or two multiples high for a loan than anybody else. Okay, but eventually you're going to stop doing that, right? Because you're losing money.
Right. And Chris, so you have 5 trade ideas in the financial sector. One of them is short United Wholesale Mortgage Corp, or
Yeah,
UWMC.
yeah.
The stock, it looks a lot like I described of Rocket Financial, where collapsed as interest rates rose because no one's going to refinance, and then it's up about 80% from its lows as interest
hmm
rates have gone down.
Well, there's a
What
specific
is so bad
reason for
about you?
that.
Is UMWC? Is it basically like a Rocket Mortgage that you think is even worse run?
No, it's because there's legislation in Washington that is going to dramatically reduce the ability of lenders, especially lenders in the mortgage brokerage channel, what we call the wholesale channel, to buy leads from people like Experian and TRW. See, right now you can pay Experian and they'll tell you that I've been looking for a mortgage. And all of a sudden I start getting phone calls from dozens of mortgage brokers around the country. I swear to God, people have been getting hundreds of calls. So there's legislation on the Hill that would shut this down and basically prevent Experian from selling your information to other lenders who don't have the right to call you, by the way. And I think that's going to hurt both Rocket and United Wholesale a lot. There's bipartisan support for this legislation. McHenry in the House is trying to hold out against it because he's very close to Experian. But I think you're going to see this pass, and then the industry is going to change as a result. Because, going back to what we were talking about, Jack, why do brokers pay Experian for leads? Because people like Cooper and Freedom and the rest of them have such huge servicing books. They can't see those mortgages. You see what I'm saying? This was a competitive reaction by the brokers in the wholesale channel to try and gain some competitive advantage so they could find out when a mortgage inside Mr. Cooper was thinking about prepaying. You see? So the guys who own big servicing books have an advantage. They know when those consumers are interested in doing something. And that's why they have big servicing books.
Mm. And just for the audience, forget the Big Short. When you hear mortgage broker, forget those 2 guys from the Big Short in Florida who are giving mortgages to everyone, people who can't afford them. Mortgage standards in the U.S. are very high, and as you referenced earlier, Chris, I mean, I knew they were super low. I didn't know they were still technically negative. Like mortgage defaults or delinquencies are
Yeah.
negative.
The
Mortgage
home
delinquencies are
prices are so hard. Imagine you default on the average mortgage and the mortgage is 3 years old, okay? The home price probably went up 20 to 30%, especially if it's a lower price home. So how are you going to lose money?
yeah.
you know?
And I'm for posterity's sake, I'm not saying that the huge surge in home prices can't start another subprime bubble that will collapse in 5 years. I'm saying on a
Yeah.
3 to 18-month view, the thing to be worried about is not mortgage credit risk. I'm just saying.
No, wait for 27, 28. In the end of my book on Stan Middleman, he talks about that and he says the maxi reset will be 2028.
Mm. Chris, another idea you had is shorting Fannie and Freddie Mac. And for the audience, these companies, they went bust and they got nationalized in 2008. And so they have been in government conservatorship, basically paying their excess profits to the government. And all of their debt and financial obligations have been made whole, except for the equity, of course, which has
Mm.
been wiped out. But it's trading at a very low
Well,
valuation
they're penny
because
stocks now.
you don't own anything.
Yeah,
Various hedge funds have gotten on the right or wrong side of this. Why do you
yeah.
want? And I think as Trump's odds of increase, Trump's market assigned perceived odds of winning the election. Some people say, oh, if Trump wins, he's going to reprivatize Fannie and
Well,
Freddie.
they said that last year. Really, these were the best performing mortgage stocks of anything in 2023. And it was fed because there was a lot of whispers here and there. There were some meetings in Washington with the Biden administration talking about Fannie and Freddie, but nothing came of it because it's really impossible to do. No matter how much we talk about this, you can't take Fannie and Freddie out of conservatorship. because the moment they're not sovereign credits, I don't think they're going to do very well. Their cost of funds will go up, their revenue is going to fall. They may have to get out of the insurance business entirely and let the federal government insure the mortgage-backed securities. So I think it's a very complicated situation. And all of the existing shareholders, the hedge funds, everybody else would love to see something happen. But the reality is, unless Congress engages on this and passes some new legislation, I don't think it's going to happen, Jack. I just don't think it's possible.
And are you hearing things that make you think that it's not going to happen?
No, but see, the way it works is this. The politicians meet at the White House and they meet at the Treasury and everything, and then they go talk to the professional staff at the Treasury who are responsible for money. Okay, politicians are responsible for policy, but they don't make decisions about money. The permanent staff of the agencies do that. And the agency wants to get paid back. The federal government's owed $200 billion from Fannie and Freddie in terms of the equity infusion that they made. Everybody says, oh, well, we've paid them back. No, you haven't, because you're renting the AAA or AA plus rating from the Treasury to keep you alive. That's what the sweep is for. So I think there's a lot of confusion on the GSEs. I worked in the ratings business. I know everybody in that business who would be concerned about Fannie Mae and Freddie Mac. All I can say to you is this: one day they will be rated as sovereigns, but the moment we talk about taking them out of conservatorship, Moody's is going to have to rate both of them as private finance companies. That will not be pretty. They will have a rating anywhere from 1 to 2 notches lower than the US rating. And I just don't know how they're going to survive.
And well, why can't they go back to the pre-2008 model of being a privately run corporation and having a implicit government guarantee? I'm not saying that's desirable, but it seems to
No,
me
we can't do
impossible.
that.
You're saying it's impossible, or basically impossible.
No, we can't pretend anymore. Basel and Dodd-Frank make that impossible. HERA, the law that Congress passed for the conservatorship, really makes that impossible. So what would happen is they would have to pay Treasury to wrap the existing and future mortgage securities with a sovereign rating. And then they would have to operate as private companies. And even with the credit line from Treasury, even with some of the other advantages that they have, they still have to compete with Jamie Dimon at JP Morgan. JP Morgan Bank is a AA credit. Would you rather have them wrap your mortgage securities, Jack, or would you rather have a rating for Fannie Mae, who wants to charge you twice as much? Keep in mind, Fannie's going to charge you 50 bips a year to wrap a mortgage-backed security. Jamie will do it for 20. Who would you rather have?
And if these things are not reprivatized, the equity has essentially no value. So you think
Correct.
it's even though Freddie Mac market cap is 900 million, you think if it's never going to be reprivatized, it should be theoretically zero.
That's correct. So what I've told people is when you see these stocks running up, when you hear the whisper campaign coming from some of these Wall Street firms who never seem to get investigated, ride it up and then sell it. But don't be foolish enough to think that they're going to come out. If you see them running, take advantage of it. But that's all it is. It's a speculative blip.
Chris, can you catch me up and our audience up on the bank regulatory reform? There was supposed to be this thing called the Basel III Endgame. I know the Basel, they meet in Switzerland from the BIS. They made their recommendation, and then the Federal Reserve and other bank regulators did a review of it and put out their own recommendations. I know you had a piece on this at your research firm, but what has been happening? Catch us up.
Well, what happened was the regulators got beat about the head and shoulders. The first proposal was not well crafted and it needed to be revised. So they went back and they revised it. And the Treasury, which is arguably controlled by the Biden administration and the Fed, all agreed. But Mr. Chopra, Rohit Chopra, the head of the Consumer Financial Protection Bureau, who's on the board of this consumer or the Federal Deposit Insurance Corporation, a lot of acronyms here, he's apparently unwilling to support the proposal. So what he said is that he's going to support the 2 Republican directors on the board of the FDIC and vote no. Now,
Why?
I don't think Marty Gruenberg, the acting chairman of the FDIC, is actually going to vote at all. So if we don't see a rule coming out pretty soon, and then, obviously we need to see the FDIC vote on it, then I think it's dead. and they'll just have to pick it up again with the new president.
And what were the regulations? I mean, there was a higher
Yes.
capital penalties
Well,
for the very
Chopra's
large banks she
mentor,
did.
yeah, Elizabeth Warren, doesn't like the proposal. She wants to get tough on banks. Elizabeth doesn't understand banking at all, but she's made a little place for herself in the progressive community by screaming and yelling about banks. Unfortunately, oftentimes she will say things that are really intemperate and inappropriate. Like she wanted the federal government to break up Citibank the other day. She sent a letter to the OCC about this. So she told Chopra that he should dig in his heels and that he should not allow this proposal to go through unless they raise the capital requirements for big banks. Big banks already have too much capital. They don't have enough risk, to be honest with you. But nobody in Washington understands this. So this whole political process is essentially ground to a halt. I think it's going to die, Jack. I really do. I don't think Chopra is going to change his mind. He has no reason to. He's going to be out of a job in a few months anyway.
And depending if the Democrats or the Republicans win in the November election, I guess I'm talking the presidency, but also the Congress, House, and Senate. What are the implications there? I presume, as is often the case, the Republicans are towards less regulation and the Democrats are towards stricter regulation, or is that not true in this instance?
I think the Republicans are concerned about regulation too, but they don't want to be silly about it. I worked very closely with Treasury and the housing agencies over the past 4 years. And I got to tell you, I am unimpressed by the caliber of the people I've been dealing with, their understanding of finance. It's not there. And you can see it in the proposals they've come out with. A lot of the proposals in the Basel framework that was put out last year were just not well considered. They weren't well constructed. They wanted to increase the risk weight on the mortgages to something over 100%. That would have been just catastrophic for the industry. And what happened was the Biden White House made the entire housing community, Democrat and Republican, come together, join forces with the banks, and attack the Basel proposal. I've never seen anything like it. So that's the reason it had to be modified. There was no way that Powell had enough votes at the Fed to pass the original proposal. He had 2 no votes, and he might have also voted no himself if it was the final rule.
And do you think there will be meaningful changes depending on who gets elected in November, not just on Basel III, but on the Consumer Financial Protection Bureau and various other types of financial regulation that impact banks in various ways?
Yes, I think the Republicans will try and change the configuration of the CFPB and make it more like the other agencies in Washington with a bipartisan commission structure. Having a single person in charge of the agency is just a recipe for disaster. The CFPB imposes fines for no reason. They just want a headline. I've had a couple of clients who've been sanctioned by them, and they really haven't done anything wrong, but this agency has unbridled power and they can pretty much do what they want unless you're willing to spend 10 or 20 or 30 million dollars litigating with them. Then you got to just give them what they want and take your abuse. But I do think you're going to see some large banks and non-bank companies suing some of these agencies next year, and it's going to be very interesting in the wake of the Supreme Court decision on Loper Bright that basically got rid of Chevron deference to federal agencies. The judges will decide from now on. And I think a lot of industries, especially mortgage, have had enough. They really have. They've been dealing with arbitrary and ridiculous rulemakings that have no basis, by the way. There's no published rationale or analysis behind many of these proposals. Like, I'll give you an example. They want people to use 2 credit scores when they make a loan. That's functionally impossible. But this is the progressive policy that's been coming out of the Biden administration.
What 2 credit scores?
Well, they are using the original FICO score, which has now been revised to include all of the new criteria. And then Experian has a score called Vantage that they've been pouring money into for the past, almost a decade now. And they basically paid enough people in Washington to force Fannie Mae and Freddie Mac to force their issuers to use both. So they have to pay for both. And the cost now is passed to consumers. Consumers have to pay for 2 different sets of credit reports. It's obscene.
And Chris, I frequently cite Fair Isaac's FICO
Hmm.
as a stock that is an example of extremely rich valuations in the stock market. The trailing 12-month PE ratio for FICO is literally over 100. And I'm sure it is a high quality business and they have an effective stranglehold on the market. But do you think that this new Vantage could be a threat to the moat of FICO?
Well, it's I think your characterization is incorrect. Experian is trying to kill FICO. Got to remember, years
That's
ago,
what I'm
all
saying.
the credit bureaus had thousands and thousands of offices around the country, and then they all rolled up into three credit repositories. These companies are essentially, monopolies. It's a three-way monopoly, and they want to get rid of FICO so they can capture the score revenue for themselves, especially Experian, which is a really aggressive and odious company, by the way. So I think that you got to realize that these are all monopolies. FICO, they provide a service, and it's a service that has been recognized in the industry as accurate. So we didn't need any change. And yet, as they say, Experian spent so much money in Washington that they were able to get what they wanted.
By the way, I'm sure many people, credit score companies, would agree with you. Why do you think Experian and is an odious company?
Because they don't really seem to care about consumers. I mean, they're selling leads to major brokers to tell them that I'm interested in getting a mortgage. What gives them the right to sell that information? It should be illegal. There's no reason to allow these people to behave this way.
Yeah, I'm sure. I mean, I agree with you, and I think many people
Well, trust
listening
me,
will agree
there's
with you.
bipartisan support for that trigger lead legislation. It's going to pass.
Yeah, man of the people. What do you think about its competitors, Equifax and TransUnion?
They're less aggressive. Experian leads the parade. All three of them own Vantage Score, by the way. They all have a piece of it, and they all have an interest in getting rid of FICO. What's funny is that nobody's asked institutional investors or the rating agencies, all of whom still use FICO. So there's a bit of a disconnect here.
So, Chris, if I were to say a few reasons why bank stocks have been rallying enormously, one is interest rates going down, a boom in capital markets activity, as well as a decline in or a stop in
Well,
an
third
increase in
quarter was a
deposit.
good quarter.
Right.
We'll take it. I think fourth
But
quarter is going to be quieter. You're going to see people taking losses and cleaning house. That's what we do in the fourth quarter. Fourth quarter for banks is usually light in terms of revenue compared to the first quarter. A lot of year-end, bookings and volumes end up getting pushed into January. So that's why the first quarter usually looks better. But it won't be horrible. I'm hoping for more stability and boring. I don't expect to see a lot of compression now because yields have backed up. And I think banks are going to be able to continue to make reasonably good asset allocation decisions. But boy, the ones who are sitting on lots of legacy 20 and 21 paper have got some decisions to make.
right, but Chris, banks are up, but they're up more than the S&P this year, and over the past
Mhm.
quarter, I mean, they're up more than tech stocks and
Oh,
Nvidia.
yeah.
They are
Well,
leading this market higher, which is something that is quite rare to say over the past few years
well, here's
about
the
banks.
interesting thing. In 23, the big banks were doing great. We got into the first quarter and people started worrying about a recession. So you saw a big sell off in some of the large caps. And all of a sudden, we publish an index on the industry every quarter. I had those small banks. Everybody in my top 25 was a little bank. I couldn't believe it. And you literally saw managers run away from the industry in the first and second quarters. Third quarter, they started coming back. And now I think you're going to see the thing melt up.
Yeah. So are you a bull on bank stocks at this moment?
On some, I still am advising my crowd to buy quality. I don't think you want to chase the mediocre names in the group. You want to look for people who are hitting it every quarter, who have good equity returns, good operating efficiency, and it's going to show in their stock market returns. The American Expresses. You talked about Synchrony before. There's a whole list of smaller companies in the banking sector who always outperform most of the large caps other than JP Morgan. And it's just a shame, the industry has such a large cap bias that they don't pay any attention. They barely pay attention to American Express. It's extraordinary.
And would you say that how do you think about the valuations of banks? Because I know in previous conversations, Chris, when bank valuations were quite a bit lower, you said some of them were not cheap. Are they too
Well,
expensive now?
Uh, they're not particularly cheap, but I think they're going to go higher. The fact
Mhm.
of whether they're cheap or not doesn't matter, Jack. All that matters is that there's a group of equity managers out there who need to allocate money to financials so they can earn their fees. That's all that matters. I've
Yeah.
gotten to the point where you can talk about excellence on the part of some of these banks, and the managers will ignore it. And then they'll go out and buy Ally Financial. Why? Because everybody's buying it and the stock price goes up. It's a low quality issuer, but it doesn't matter because everybody thinks that that's a good surrogate for consumer. So if there's a recession, as I said in my 5 ideas, it goes down. If there's not a recession, it goes up. But there's so many other players that are much better lenders in the consumer space than Ally. So it
And
is what it is.
one of your 5 ideas was Ally, and it was, just to be clear, it was a short, right?
Well, it depends. If we have a recession, it's a short. If we don't have a recession, it's probably going to go back up.
So could you say that, Chris, about the entire banking sector? If we have a recession, financials go down. If there's no recession, melt up.
Well, it depends. The enduring names like JP don't go down very much. Managers want to own it regardless. You have that with some of the other better performing names, the smaller names. The rest of them kind of ebb and flow depending on what the headlines are, and it can change very rapidly. But I say go look at I'll send it to you after the call. Look at the components of our index over the
Mhm.
last 4 quarters, and it's quite remarkable how much change there was.
Yes, I have noticed that. So, your one long in your ideas is New Holdings, and I'd heard of this name before, Chris. I
Yes.
looked it up. I never looked into it. I looked it up just in preparation for this call. The numbers look so good. It looks like something funny is going on. What is going on?
No, it came out a few years ago, IPO'd, the stock crashed. Typical IPO story. It's an offshore issuer based in Caymans, and they are starting consumer banking and or non-bank operations in a number of Latin American countries, depending on the legal environment. So if they can be a bank, in Brazil or Mexico, for example, they do. If they can do just non-bank finance in other countries, they do that. They have a leg down in the U.S., so they can work on the payments flow between the U.S. and these other nations. I just think it's an interesting model. I've been in the stock for over a year, and I think it's a slow growth story. There's nothing particularly sexy here, but they are making money, and they seem to have a very flat, nimble management structure, which I like. So I've been following them. There's not too many new stories in finance out there that I can really get excited about. A lot of the fintech names turned into banks, and as you know, that's the kiss of death. Once they become banks, they become boring. So I would just watch this one because I can't think of many other names in Latin America, particularly, that are worth following. You have Meli, the marketplace. There's a couple of others, but I thought this one was interesting.
Yeah, I might disagree with you, Chris. For a stock, it's no Nvidia, but it is having earnings and revenue growth like not a lot of banks. I'll say that.
Well, it's not. It's a non-bank that has a couple of bank licenses here and there. I wouldn't disparage them by calling them a bank. I think
Okay.
they have a culture that is much more aggressive that you typically find in a non-bank sort of organization. And these are very rapidly growing markets. They have very good market share in Brazil and Mexico. So for me, I think they're in the right place. You can't compare the growth rates in these nations with the U.S. They're much faster.
Right.
They're in Uruguay. I have many family members on the ground in Uruguay who are familiar with them, so I hear about it all the time.
Very nice, Chris. I want to close by asking you about non-banks. There has been a tremendous growth in the assets that are now called private credit. So loans
Yeah.
that used to be made in banks are now increasingly made outside of the banking system, and there's been an enormous amount of fundraising and lending in names such as Apollo, Ares, KKR, Blackstone, and those publicly traded stocks of those general partners, the GPs. Those stocks are on fire. What do
Mm.
you think of this sector? Do you think it will end well? It will end badly? Are you jealous of the growth as someone who's within the banking system? You want that growth to be back in the banking system? Tell us your thoughts.
Well, the banks end up financing this stuff. Ares, Apollo, the rest of them are managers. And they position themselves for a recession. The private credit trade spread everywhere. You had retail asset managers all over the world, names that you wouldn't think would associate themselves with this sort of stuff, all offering their customers private credit opportunities. Now, that trade's pretty much over. We're not going to have a big explosive recession. So private credit, the yields are down in kind of low double digits, high single digits now. It's not that attractive. And, Aries and the rest of them will find something else to do. Don't worry about them. But I think the whole private credit trade was overblown.
You said the banks finance them. What do you mean? Because the Aries Apollo, they raise money from wealthy people, endowments. They don't raise it from the banks, and
Well,
it's
yes, they
supposed.
do. Yes, they do. It depends. They have a combination of equity financing from clients, and then they will also get credit lines that are secured by assets from banks. Banks play here. Don't fool yourself, because the numbers are big. Private credit in commercial real estate, for example, is huge. Trillions of dollars. There isn't trillions of dollars out there in equity financing from investors for these deals. So you have to combine debt and equity, and the manager goes and works the assets and tries to make some money on the outcome. But it's a risky business. You're buying assets at very cheap levels, and you're trying to fix them. And they may be fixable or they may not be fixable depending on the situation. Every situation is different. This is not a homogeneous asset class, not at all. So I think the biggest part of it's commercial real estate. Then you have companies that financed themselves a couple of years ago and that are busted and need to be fixed. There's lots of that. I haven't heard anybody going into Chinese real estate, but I'm sure that will come.
So yeah, banks are a player. I actually only learned that over the past few months. Chris, I think a lot of people were like me, unaware of how big banks are in private credit and lending to them.
They
As a matter of
always
fact,
do
I spoke to
secured
someone who
funding.
was an expert in this, and he said he's not worried about it private credit from a systemic point of view because banks aren't lending, and as we both know, that they are.
But they lend it very, very, they're taking 30-40% of the stack, and the rest of it could be equity.
Mhm.
So it depends on the asset. That's everything. You have to underwrite the asset, find out where you own it, and maybe you can convince a bank to come help you finance it, especially if it's commercial real estate.
And so, Chris, what are the characteristics of your Whalen Global Banking Index that make them in your high performing banks? And why do you think that these? So it's fair to say you wouldn't say the banks are going to rip because it includes a lot of banks that you don't like, but I think it's fair to say you would say the Whalen Global 50 will rip because you're bullish on those. What are the characteristics of those names?
What we do is we mix traditional Wall Street practice, which is to be selecting assets by size. So KBW, for example, is a classic example of this. 24 banks, mostly large caps, that are supposed to be representative, but are basically picked because they're big, not because they perform well. What we do instead is we test them by size, equity returns, total market returns, operating efficiency, two or three other things, and put it all together and score them every quarter. So we tell our clients these are the best performing banks in the country now. And what we think, both for equity and for credit, is if you're really concerned about performance, either in terms of price for the stocks or in terms of credit for risk exposures, you want to know who the best banks are. There's no reason to own the bottom quarter, right? Our top 10 is absurd. They are some of the best banks in the country quarter in, quarter out, but they tend to be smaller. So Wall Street ignores them. But I think our top 25 is probably the best representative slice of really good banks. The top 50, it's half of our group. So there's going to be banks in there that are far less righteous than leaders. But the top 10 is great fun. I love watching that. We're getting ready to rebalance in 2 weeks.
Chris, thank you so much for joining us. People can find you on Twitter at RC Whalen. You've got two books that are out. The first is Seeing Around Corners, Achieving Success in Business and in Life. It's about the mortgage servicing right kingpin that we talked about, Stan Middleman. And the second book is the second edition of Inflated. Tell us what's new about the second edition of this book.
Well, I rewrote the last three chapters. I had to add a chapter for the past 15 years. So we spend a lot of time on quantitative easing and Jay Powell and his little adventure at the Fed over the past few years. I am not a big fan of Powell. I think he's been one of the more problematic Fed chairman in the history of the organization. And then we talk about the dollar and where this whole American dream is going to end. I am not nearly as bearish as some people are on the United States. I think that we can solve most of our problems. And I'm not looking for any of the wannabe countries around the world to replace the dollar anytime soon. What I found with my research, Jack, which I'm sure you'll find interesting, is that countries are reducing their use of the dollar very gradually, but they're putting it not in yuan or not in the euro, but they're putting it into other currencies, mostly their own trading partners. So I think that's kind of an interesting situation, and I think it's healthy. I would love to see the dollar get pushed down below a third of global reserve assets, because I think it would be good for the United States if we had a little more diversity.
Very interesting. Chris, thanks so much for joining us. People can find Monetary Matters not just on YouTube, but on Apple Podcast and Spotify, and they can expect regular episodes coming out every Wednesday and Sunday. Thanks again for coming on, Chris, and thanks everyone for watching.
My pleasure.
Thank you. Just close the door.